Imagine getting a paycheck from the stock market every single month. Not quarterly, not twice a year, every single month. That's exactly what these 5 dividend stocks can do for you, and you don't need to be rich to get started. Most people don't realize that the majority of dividend stocks pay out quarterly, which means you're waiting 3 months between checks. That's fine, but if you're trying to build a passive income stream that actually feels consistent, monthly payers are where it gets interesting. You can reinvest faster, budget more easily, and honestly, it just feels more real when that deposit hits your account regularly. So let's get into it. These are 5 dividend stocks that pay you every single month, along with what you need to know before you buy any of them. First up is Realty Income Corporation, ticker O. This one has a nickname. It literally calls itself the Monthly Dividend Company. And it backs that up. Realty Income is a real estate investment trust, or REIT, that owns thousands of commercial properties across the country. We're talking Walgreens, Dollar General, FedEx facilities. Stable tenants, long-term leases. As of recent data, it's been yielding somewhere in the 5 to 6% range, and it has raised its dividend over 120 times since going public in 1994. That's not a typo. For someone building a passive income foundation, this is one of the most well-known names in the monthly dividend space for a reason. Just understand that REITs can be sensitive to interest rate changes, so keep that in mind when you're sizing your position. Number 2 is Stag Industrial, ticker STAG. Think of this as Realty Income's more industrial cousin. Stag owns warehouses and distribution centers, the kind of properties that e-commerce companies and manufacturers depend on. As online shopping has grown, demand for this type of space has stayed strong. Stag also pays monthly and has historically yielded around 4%. It's a smaller portfolio than Realty Income, which means slightly more concentration risk, but it also gives you exposure to the industrial real estate trend that isn't going away anytime soon. Good diversifier if you already own O and want to spread across different property types. Third on the list is Main Street Capital, ticker MAIN. This one is a little different. Main Street is a business development company, or BDC, which means it lends money and takes equity stakes in small and mid-sized private businesses. Think of it like a mini private equity firm that you can actually invest in through a regular brokerage account. Main Street has a strong track record of managing its portfolio conservatively, and it regularly pays both a base monthly dividend and special dividends on top of that. The yield has historically been in the 6 to 7% range. Now, BDCs do carry more credit risk than REITs. If the companies they lend to struggle, that can impact the dividend. But Main Street has navigated multiple economic cycles well, and it's considered one of the higher quality operators in its space. Number 4 is EPD, or Enterprise Products Partners. This is a master limited partnership, or LP, that operates pipelines, storage terminals, and processing facilities for oil and gas. Energy infrastructure, basically. Enterprise has been paying and growing its distribution for over 25 consecutive years. The yield typically sits in the 7% range, which makes it one of the higher income options on this list. One thing to know about MLPs: they issue a K-1 tax form instead of a standard 1099, which can make tax filing slightly more complicated. Some people hold MLPs in taxable accounts. Some prefer to avoid that extra step altogether. It's worth knowing before you buy. But if you want serious income and don't mind that wrinkle, Enterprise is one of the most financially solid MLPs out there. Fifth is Agree Realty, ticker ADC. This is another REIT, but it's worth separating from Realty Income because it has a slightly different focus. Agree tends to concentrate on what analysts call necessity-based retail: grocery stores, home improvement, dollar stores, auto parts retailers. The kind of businesses that hold up even when the economy gets shaky, because people still need to buy food and fix their cars. Agree switched to monthly dividend payments a few years ago, and the yield has been in the 4 to 5% range. The portfolio quality is high, and it's often seen as a growth-oriented REIT compared to some of its peers. If you want a monthly payer with a cleaner, more modern tenant mix, Agree Realty is worth a serious look. Now, a few things before you run out and buy all 5. None of this is personalized financial advice. These are starting points for your own research, not a buy list handed down from the mountain. Every one of these companies comes with its own risk profile, and yields can and do get cut when business conditions change. Higher yield almost always means higher risk somewhere in the equation. That said, what makes these 5 interesting as a group is the diversification they offer. You've got commercial real estate, industrial real estate, private business lending, energy infrastructure, and necessity retail. 5 different sectors, 5 monthly income streams, all accessible through a standard brokerage account. If you're reinvesting those dividends, you're compounding across all 5 of them at the same time. That's how this works in the long run. It's not about getting rich overnight. It's about building a machine that gets a little bigger every single month. If you're brand new to dividend investing, start small. Get familiar with how these assets behave and build from there. The goal is income that grows over time, and consistency matters more than chasing the highest yield you can find. If you found this helpful and want more videos about building real passive income streams, hit the like button. It genuinely helps this channel reach more people. And if you're not subscribed to YieldPath yet, now's the time. We cover dividend investing, index funds, side hustles, and practical money strategies every week. Subscribe so you don't miss what's coming next.